So take a look at this terminal here. It's the correlation between the S&P and the 10-year. We did have positive correlation, which basically means that they can move in tandem, buy equities, sell bonds. But that correlation is dangerously close now to turning negative. So what would a negative correlation mean for the yield in the S&P?
Not that much, honestly. If you look at the history of this and you look at the price to yield, for example, which is the inverse of the 10-year yield against the PE of the market, they actually broke apart starting back in 2008, and they've been kind of disconnected for about 10 years. Much, much higher valuations in bonds than you have in stocks. So part of that is high equity risk premiums, fears that we aren't going to get growth, that there are going to be some issues. And there have been a bunch of issues along the way, right? Think about the periphery debt crisis back in 2011-12, the end of the commodity super cycle in 2014. So there have been kind of distortions. And I think just focusing on the 10-year yield and not thinking about risk premiums is kind of missing the point.
So at what point does the interest rate really start to affect earnings? Because, in fact, the cost of capital goes up because it's been notoriously low, as we just heard from Steve Schwarzman.
So there are two different elements to it. First of all, at what level should you worry about the bond yield is part of the question. Right. And I would say that the work we've done would say somewhere north of 3.25% would probably be challenging because you would have that risk premium factor kind of go away as the offset. And we did this work back in October, November last year. The second piece of it is, and this goes specifically to the cost of capital for business, that despite the fact that the Fed has raised rates 5 times already, cost of capital for business is better than it was when they began the rate hiking cycle because the the credit spreads have come in so dramatically and have been very tight. This is partially technical in terms of central bank buying, and it's partially because there hasn't been a lot of issuance. So you put those two together, and businesses have really, really easy access to cheap capital still, and we have not had tightening. That's the most amazing element. And it's not about giving it to private equity like you were talking about before, where there isn't kind of a rate associated with it, and it's a 5 to 8 year time frame that you're looking at in terms of the returns without a mark to market. I mean, that's the beauty of some of those products. Yeah. That you don't have to deal with that on a day-to-day basis, and you're buying a business and investing, quote unquote, for the long term, not about what happens in the next few weeks or days in the markets.